Yes, this is quite interesting, the private equity side of things, because on the one side you think, how do you build a real estate valuation model? And then you've got a private equity valuation model and you think it's substantially different. And the only difference really is how compensation structure works, the waterfall structure work, and how you model that based on, the returns required from the investor and then of course everyone that takes part of it. So throughout this webinar, we're going to first of all start with defining what a PE fund is, how it works, how it operates, some of the key players in your general partners, your limited partners, what their responsibilities are. And then we're also going to look at the fund structure and how it's usually put together and the life cycle of that type of structure of these PE funds, because as we know, it's quite illiquid and there's a lot of lockup going on. And then finally, we'll get to the fun stuff, which is really the differentiator between just a typical real estate commercial valuation model, where we're going to look at the financial targets, how that is split up, and how the GPs are incentivized to do well for you as an LP. So I think to start off with, a PE fund is essentially just a fund that pools capital together, both debt and equity, to acquire and manage a real estate asset over time. Now, I specifically put this vintage sentence in here as well because it is raised per vintage. And what we mean by vintage, which we discussed in the previous webinar, is every year these GPs will raise capital for a vintage to deploy the capital based on the opportunities and the market environment at hand. So a vintage of 2017 would be substantially different from a vintage of 2022, for example, pre and post COVID, especially the component parts or the individual assets that's being invested in during that point in time. A lot of things have changed. You would probably see more vintages now in the 2025, 2024 vintages that are looking at, data centers, where prior to COVID, it was a lot more focused on commercial properties as well. But ultimately, you've got your capital commitment component in a private equity fund. You have a specific fund life, and then you've got a legal structure that you follow. And then you also got, the investment focus or the investment output expectations. And what's quite interesting is that when you, as an LP, you and me, for example, um, we would invest or we would commit capital to a GP, but it wouldn't automatically be deployed immediately. It typically takes a bit of time for it to be deployed. We'll touch a bit more on the details of that a bit later. But ultimately, let's assume you're working with an investment manager, you're in a high net worth individual, and let's say you've got 5% of your portfolio, of your multi-asset portfolio, that's what MAP stands for, is committed to private equity. That 5 percentage points is not deployed immediately. It's deployed over time, which means that sometimes that 5 percentage points of your total portfolio will also be managed in a more liquid fashion until capital calls come in. And this fund life cycle varies, but it's typically between 7 to 12 years, depending on the type of the PE structure or the PE fund that you're investing in. And your capital is only fully deployed probably around year 3 as the calls come in. And then after between 3 and 5, then you start seeing your distributions, which shows you the whole J curve where you commit, and then the distribution starts to take effect. But you're really relying on the GP to do a good job with that. The partnership structure is typically a limited partnership, which means that you and me who invest the capital or commit the capital, that is the only risk we have, is the capital that we commit. And the investment focus, of course, it's typically invested in liquid assets, and it's also based on a lockup period for quite some time. So you do require a bit of a liquidity premium to compensate for that. Let's first talk about the GP. I think the simplest of terms, it's just the fund manager. It's your BlackRock, it's your Blackstone, whoever is raising the capital from you, and they effectively just deploy the money that you give them or the capital that you commit to these assets, to these opportunities. They're responsible for sourcing the deals, so finding these value add opportunities to raise capital, both debt and equity. So they'll probably get equity from you and then various other people as well, depending on the size of the deal, and then get the debt associated with that, senior plus mezzanine, whatever is necessary. and they will execute the deal. So they purchase the assets and then they'll manage that over time, and that's what we pay them for. That's the management fee that we pay them for, which is around 1 to 2%. Now that's just kind of like their base salary, the the component that you have to pay for their services over time. But then you also have performance-based fees, which is the carried interest, which they get when they achieve a specific hurdle. So they are incentivized to do really well based on an incentive-based performance structure, and they only get that bonus if they achieve the targets set by the LP. So if we have a preferred return of 8%, hypothetically, they can only start getting a bonus if we've already exceeded the 8%, but that varies between a European style and a American style approach, which we will discuss as well. So the limited partners, I looked at this for quite some time, and I thought to myself, I don't fit into any of these categories, so I can't really speak from experience. But having dealt with a lot of high net worth individuals in the past, you know, if you have a if a private equity fund requires a 10% or 10 million pound buy-in as a minimum, you're looking at high net worth individuals with at least, and let's say your PE exposure based on your advisor is 5%, you're looking at least a net worth of 200 million just to buy private equity, if that makes sense. So it's incredibly, it's quite a high hurdle to get into private equity overall. But you've got your high net worth individuals at the top. They expect risk adjusted returns. They would like to see their money grow, get some alternative risk premia so that they can diversify across asset classes. Then you've got your endowments. A simple example would be Cambridge and Oxford. They've got they're colleges. They have endowment funds. They love private equity. They always have. And what they're focused on, getting a specific return based on beyond inflation to keep that number ticking over time for future generations. And then you've got your sovereign wealth funds, which is focused on national interests. So they have specific targets and certain national interests that they need to finance. So they also look for capital preservation in that sense. And then family offices is, large individuals who's got an entire family office just to manage their finances. They want this kind of exposure to exceed inflation over time, to help exceed their returns over inflation over time so that they can grow their assets, but also preserve their capital. And then you've got your insurance companies and your pension funds. And for them, it's a lot about liability matching. If you're not familiar with that, so let's say you've got a DB pension scheme and you've got specific liabilities that needs to be paid out at a specific point in time, they need to have that capital available when it will be called on by the beneficiaries of that. So it's all about capital preservation, but also growing it to the extent that they can meet their liabilities. And private equity do tend to lend itself to helping portfolios achieve those kind of returns. So, I mean, in the simplest of terms, your LP, they provide the capital, we provide it to the GP. We don't have operational control, and we'll talk about blind pools a bit later. But ultimately, you don't have operational control in terms of, in the same sense that you would buy a stock in your portfolio. You can tell your investment advisor, I don't want to own X, I don't want to own that, or I want to own Microsoft. I don't want to own Apple, for example, where in the public market, where in here the GP makes that decision. So you don't really have an influence on selecting the deals, but you do have a return expectation. So you can tell them, I want, this is the return that I want. And then anything in excess, we can split based on that. And that's typically around 8% before the GP can earn any carry or any bonus associated with the value that they're adding. Now, I put this in here. I didn't want to confuse people with this, but these underlying assets within a private equity fund, they are usually within a wrapper, these portfolio companies. So let's say the private equity fund focuses on stabilized assets, for example, which is your typical commercial properties situated in a very prestigious area. It's got high quality tenants, your government officials, lawyers, bankers, etc. So there's a lot of stability in there. Each of these assets that you purchase are pretty much wrapped in an SPV, a special purpose vehicle. So each property sits within its own SPV, and then the fund holds a stake within that SPV. depending on the structure that you've initially decided on. And then these SPVs and the performance of these SPVs effectively gives you your return of the entire fund overall. So an SPV is essentially a standalone wrapper or a legal entity, usually an LLC or a trust. And the whole purpose of it is to acquire and manage that individual assets, but we'll touch a bit more on that later. And what makes it interesting is you can have an SPV focused on stabilized asset. You could hold an SPV holding a value add asset, and you can have one that's holding opportunistic assets, and you can split it in terms of the capital that's being deployed 50%, 50, 30, 20, for example, and you can optimize your portfolio based on the risk adjusted returns that you're expecting for those SPVs. But we'll talk about this in this slide. So the reason that SPVs are used is because you can just, well, the first thing is the exit is simpler. You can just, offload the SPV rather than the individual or unwinding the direct holdings. You also got liability isolation. And what we mean by that is, let's say you hold 4 SPVs in the fund. One doesn't terribly well, goes bankrupt. It's an absolute mess. It doesn't affect the other 3. So it's its own little legal entity. So that's the benefit in that respect. It's got some tax efficiency. I'm not going to touch too much on that, but you also have some ownership clarity. So the capital structure, if it's a joint venture, if it's debt and equity finance, can be applied to each SPV individually. And I think the best way to fully understand as an analogy what an SPV does or how it fits within this is to compare it with a public equity fund, for example. So in a public equity fund, you buy shares in a company. So let's say you've got a portfolio of 15 stocks, Apple, whatever, you name it. The equivalent of that in a private equity fund is an individual SPV. The legal structure is slightly different. In the UK, we've got open-ended investment companies or trusts, where the legal structure in this SPV is usually limited partnerships. And then the asset ownership, you don't really have much control in a public equity fund in terms of anything related to that stock. You can vote in AGMs and all of those things, that's fine. But in an SPV, you actually, the GP on your behalf has direct or a controlling interest in that SPV because they manage that on your behalf. That's what we're paying them for. So that just splits a bit of a, or hopefully that's just clarifying exactly where the SPV element sits within this fund. Now, in terms of the fund structure and the life cycle, we've touched on this briefly earlier, but how this typically works is you've got your fundraising period. So BlackRock or Blackstone, I'm just going to use them because they're well known. They would go to, let's say, a large investment manager, and they would say, listen, we have this new opportunity that we're going to invest in. We're going to, or this is the mandate. These are the assets that we're going to hope to invest in. We want to raise some capital. And then your investment advisors say, yes, let's go ahead. And you'll have an investment period of 1 to 3 years in which those capital will be deployed. Maybe in the first 2 years, again, not all of your capital will be deployed immediately. That will be managed kind of separately until the capital calls come in. And you'll hold it for about, 3 to 7 years. But interestingly enough, the exit also takes a couple of years to unwind these assets. But during that time, you will have committed capital. Capital would have been distributed. And that's why you've got the whole waterfall structure overall. So in summary, you've got your fundraising period, you've got your investment period, you've got your holding and management period, and then you've got your exit period. And that kind of varies by depending on the structure that you followed. So you've got a blind pool structure, which is the most common. That BlackRock would say, we want to raise, for commercial property investment, we want to raise X amount. You can say yes, but you've got no idea what they're investing in whatsoever. So you're committing your capital to them without knowing what they're going to invest in. So there's a lot of trust in following the blind pool approach. So it's all about reputation of your GP because you've got no idea, what they're going to invest in. Less common is a deal by deal structure. I think that's a bit more associated with the American style of things because the compensation can also be American style, where it's less common, but you have at least kind of an idea of the deal. They would say, okay, we're explicitly going to invest in data centers, for example, rather than just giving it over to their own account. And so that's a slight difference between those processes. So this is the interesting part. This is kind of the foundation of the whole waterfall structure. And this is what's the key difference between just running a model, looking at the IRR and NPV, and how that is then distributed. Because ultimately, when you look at a model and we have an IRR of X and an NPV that's positive, we know that the investment is viable. This breaks those viability elements, so the excess return that you're achieving, breaks it down into component parts and split based on compensation. So you'll have your management fee, which we've discussed earlier, 1 to 2% for the GP that you pay regardless of how the fund does. It's essentially their base salary. Then you've got the preferred return, and I'm deliberately jumping to the third point here. I'll explain that now, but then you've got the preferred return, you and me saying we want at least 8% from this. And that's what must be achieved before the GP can start earning their bonus. So they still earn they still earn the 1 to 2% management fee, but any bonus needs to exceed our preferred return first. So there's quite a bit of protection associated with that for the LPs. And the carried interest is the bonus component. So that's usually like a 20% split. So if you have excess of 8 million capital, you can say they need to earn 20% of that. And that's 50-50 split. So I don't know what the exact math is. We've got an example coming up in the next slide, but ultimately that is then split. Everything that exceeds the preferred return is then first split in a catch-up clause where they can, until the GP receives 20% of that excess return, split between you and the GP. And then you've got your further splits if you're 80-20, and that's where the waterfall structure comes in. But what does that look like? So I've created a very simple example here for you all. Assuming we're buying, a property, it's 20 million. We raised, 12 million of that we raised as debt. And the equity component is the rest, is 8 million, split 90% between the LP and the GP. And we sell the property for 30 million after 5 years, and after fees, the net proceeds are 28 million. So you can already see we've got about 8 million to play with, right? But from that 8 million, from this entire amount, we first need to repay the senior debt. Then we need to return everyone's capital. Then we need to pay the preferred return to the LP, and then the GP can earn its catch up with the further splits. So it does vary based on European and American style. I've got a table at the end just to do a further comparison. But, European style is all at the fund level. So if the entire fund exceeds a specific hurdle rate or the preferred return, only then can the GP actually get that bonus. And the American style, they can do it deal by deal by deal. So think of it as SPV by SPV. So they could already achieve, or they can already obtain a bonus if one SPV exceeds it substantially and other ones do not. So there's slightly weaker protection based on that. But the pure mathematics of this, let me just check the time. I seem to be okay. Let's put that into numbers. We've got a 28 million. That's what we sold the property for after fees. The outstanding loan, so the debt that we have to service, is 12 million. So there's 16 million left. We have to repay 8 million of capital, which is split 7.2 and 800K between the LP and the GP. So what remains is 8 million of proceeds that now needs to be distributed. However, we have the LP's preferred return that needs to be paid first before any waterfall structure can fall into place. And that's essentially taking the 7.2 million that was committed initially, and then calculating what the excess return would be by compounding it at 8% over 5 years, looking at the differential. And that is essentially the preferred return required by the LP. And then when we take the 8 million and we subtract that number, we have 4.62 million left. The GP catch-up clause now kicks in. So the GP can earn 20% promote. So of that 8 million, 20% of that 8 million is 1.6 million. It's a 50-50 split. So they earn 1.6 million, you earn 1.6 million. So that's a total of 3.2 million, which you then subtract from this amount from the remaining proceeds, which gives you a new remaining proceeds of 1.4 million. And then that is split 80-20 accordingly. And then how this is tabulated effectively is, here's your initial capital outlay. That's the preferred return that the LP should receive. That's the 50-50 split between the LP and the GP, and then the 80-20 split that remains. And that's essentially a summary of your capital structure. And I put this table here at the bottom. It's because I don't think it's incredibly viable, but it's important to note because you do see in some models a lot of errors occur. People applying European style approach rather than an American style approach, or an American style approach rather than a European style approach. The waterfall structure, even though it's simplistic in nature, modeling it is sometimes complicated and it's easy to make a mistake. So just some key elements here. In terms of the European style waterfall, it's based on the entire fund. We've already touched on that, and the American style is on the individual deal by deal basis. The GP can only earn in a European style after the LP has received their preferred return, where the LPs, where in the American style, they can do that based on each deal. So that can distort your returns. Clawback requirements is just essentially if, let's say, they it's more applicable to the American style because if you started, on that individual deal started getting carried interest, the GP started getting carried interest, and the fund fails in the final year, you can have a clawback clause so where the LP can get some of their capital back. But that's mostly applicable to American style. It's common in that, but not so much in European style because you're paying it on a fund level rather than the individual deal level. And the protection is in generally more higher in European style than American style, which goes without saying. But even though these numbers is quite simplified, there's a lot more to a private equity model in terms of multiples and performance metrics, which we will cover in next week's webinar a bit in more detail.